Welcome everybody to the last session of the 2019 NAGDCA conference. Give yourselves a round of applause for staying. We've got a great session, thank you. Very awesome. A couple of housekeeping items. Daniel Albert, if you happen to be in the room, hotel security has your bags and personal items, so please make sure to go there and collect them before you leave. Also, we're going to be taking questions via the app, so hopefully you all downloaded the NAGDCA 2019 app by now. You can submit any questions through the app throughout the session. I have multiple iPads, one with some of the agenda and one with the questions, so I'll be able to see them and direct them to our wonderful panel. So we've got a great panel. We're going to be talking about industry innovations. I know that's why you all stuck around. We had a great NAGDCA this year, lots of great topics, but what does the future look like? We've got a great panel, and I'm going to go just briefly introduce them because their bios are in the agenda. We've got Mr. President, soon to be former President, Jacob O'Shaughnessy. He's a consultant registered investment advisor from Sageview Advisors. Welcome, Jacob.
Thank you, Jeff. It's good to be here.
We've got David Ireland. He is with State Street Global Advisors. David, always a pleasure talking with you. Glad to hear your insights.
Thank you.
And Dan Morrison from Empower Retirement runs the government markets for Empower. So we have a great representation from the record-keeping community. And last but certainly not least, on the end seat, Joshua Cohen. He is defined contribution practice leader for PGIM, Prudential Global Investment Management. Great candidates, not candidates, you're not running for anything, but, or maybe you are.
Just one day.
You know, I always wanted to moderate a debate, so.
Right.
But this isn't a debate. This is really looking at the future, today, tomorrow, 5 years down the road. What does retirement look like? So earlier on at NAGDCA, you had a great legislative panel chaired by Paul Bedell. You heard from those folks. We're going to kind of take that off the table because we're going to let Congress and the regulators do what they need to do, hopefully. But we're going to talk about what can the industry do for the future of retirement. So let's start off with, what does retirement mean to you? So I'm going to go down the line. I'm going to start with you, Jake. What does retirement mean to you?
Retirement to me actually doesn't necessarily mean stopping working. Retirement to me means being able to achieve your long-term goals as you're in your mid to late mid-years, say 50s and 60s. And it seems these days the definition of retirement is changing. Retirement to some may mean working in a career which is more maybe personally satisfying and not having to focus as much on the financial aspects of your work. Being able to enjoy your work more for personal reasons than financial reasons. And it may be the case that you don't want to work at all. But by saving for that and helping your financial priorities not be as important, it allows you to focus on more of the things you enjoy in life.
Great. And I just want to say, so we're going to define two things in this beginning part of the session. The first is, what does retirement mean? And then what does innovation mean? Because I think two things are really important to set the table here. David, let's come to you. What does retirement mean to you?
Yeah, I mean, I think it's a lot of what Jake said. I mean, it's essentially, it's allowing people to do their jobs, what they show up every day to do, their daily function, and not have to worry about it, not have to worry about the saving, having more clarity around the spending phase, helping them draw down their assets in a safe and very clear way.
Yeah. Awesome. Daniel?
Yeah, so first, thanks for joining us, and thanks for making it through all the sessions. We appreciate you being out in the audience. I'll take a little different spin on it, Jeff. I agree with my colleagues up here on what retirement means to me. I would say what retirement means to me as a service provider, and I anticipate what retirement means to many of you, is what are we doing to help our members, our participants, our employees to know that they need to save. They probably need to save above and beyond the traditional governmental defined benefit plans, and it's our civic duty to provide them with the tools and ultimately help them achieve the outcomes so that they can go and live in that retirement.
Very good.
That would be my focus.
Awesome. Josh?
Yeah, I would just add, I mean, can't dispute anything that's said, but I think there's a reason we're talking retirement, and then all of a sudden we're having all these conversations on things like financial wellness and beyond that, because the reality is we can't think of these things in isolation. Oftentimes, we as an industry or plan sponsors, we're in our silos, we're in our buckets, we think about that, but individuals don't think that way. You know, they think much more holistically about their dollars and where you spend it and how to think about it. So I think retirement all of a sudden is getting broadened much more broadly to all these other topics because that's the way, you know, our beneficiaries and participants need to think about it.
Yeah. You know, what I love about NAGDA is we all take our jerseys off. I'm just going to steal Jake's line. We all take our jerseys off, and we're collaborating. I think this is probably the most collaborative conference organization I've ever been a part of. This is my 10th NAGDA. So I'm really, really happy to be a part of this. Josh, let's start with you. Innovation. Right. So we define retirement. Everyone defined retirement from their perspective as an organization, what they do, and for themselves. But let's talk about what innovation means.
Yeah. Well, I think it has two parts. One is doing things that isn't being done today, that others aren't doing, but for better outcomes. So there's really two pieces of that. So we are a pretty risk-averse industry, I think, in general, and probably rightfully so. I mean, we have such an important responsibility, and the decisions we make really impact individuals. And there's also legal issues and fiduciary concerns, very real concerns. It's probably good that we're more conservative. That being said, there is often worries about innovation. I had a plan sponsor recently, when we were talking about retirement income, which I'm sure is a topic we'll talk about, say, well, I will do this when 20% of my peers are doing this. And that's very common. Actually, a lot of people who look at innovation say folks want to be not the first 20%, but then not the last 20% either, yeah. Somewhere in the middle. So that's the innovator's dilemma. How do you kind of move forward there? You know, there's another expression that people would rather fail conventionally than succeed unconventionally. So, you know, it's really kind of pushing the envelope a little bit more, but you don't want to innovate just for the sake of innovation. You know, there is a lot of people are talking about outcomes these days, and I think that's the focus that we need to have, is not on products. I was thinking about this from the presentation Monday morning about storytelling, and it's not the what, which is, I guess, as your neocortex gets enhanced, but it's the limbic system, the why. Why are we doing this? Make sure we're doing things for a better outcome. And, you know, the last 3 days, I heard a lot of innovative things when you go through these sessions. There's a lot of things out there that we can do. And I'm actually very bullish on what the public sector can do in this space. I think actually you have, in the public sector, an opportunity, maybe even better than a lot of your peers in the corporate space, to really push forward. First of all, you don't have some of the legal sort of concerns that others have, but also I think you have this more paternalistic view. A lot of you have a DB legacy, and I think there's a real opportunity to bring some of these investment solutions, plan design solutions and such to the benefit of participants in the DC plans.
Dan, your Empower is one of many, several major record keeper service providers. What does innovation mean to you from that perspective?
Yeah, so first, I think Jeff and everyone here, innovation is critical to our success, and back to the mission of helping you as plan sponsors, helping participants, you know, achieve their outcomes. Innovation is a big piece of that. I think you need to start with a foundation. We all need a very clear understanding of our consumers, right? So it's, what are the desired outcomes? What are the needs? What are the limitations? And then we need to evolve and innovate from there. To me, you know, yes, you come up with some new things that are pretty cool you haven't seen before, but to me, I think in our business, innovation is really taking, putting new application to something that's very familiar. Right, so you think out of context of retirement, you think of Apple and iPhones, right? Apple was not the first to provide a smartphone, but what they've done is they've made it very easy, intuitive to use, and they've really changed the way that people now use modern computers. You bring that into industry and you think about something like health savings accounts, whatever variation you might have in your system, and standalone health savings accounts, the adoption rates are okay, right? When you couple that with a retirement view and you integrate that experience, you get much better outcomes. So that's an innovative way to take something that's familiar and put new application. I think to be successful there, in addition to the foundation of understanding your client, your customer needs, you need the right team, right? You need a group that has a growth mindset, folks that are willing to take some chances and challenge. I also think you need technology, you need process with that, and then equally as important, I think you need to bring diversity of thought into the way that you're doing things. You need to look at things differently, and to achieve that, I think you need diverse teams and diverse mindsets, coming together to come up with those innovations.
Yeah. David, your firm's obviously one of the many major asset managers innovating new products and services. Give us the innovation from your perspective.
Yeah, I mean, I think it dovetails really nicely with what these guys are saying. I mean, you heard outcomes over and over again there, right? It's finding creative ways to address a participant need that's not being addressed with an existing solution. So how can you simply improve outcomes or that individual user experience? I mean, I think back to the late 90s, some of those public service announcements that we used to see, right? Don't get into cars with strangers, and don't meet people off the internet. That was conventional wisdom 20 years ago. Yeah. What did I do when I landed earlier this week? I pulled out my smartphone, I opened up my Uber app, I summoned a stranger off the internet, and I jumped into their car. You know what? And sorry, Mom, but it was a better experience, right? I mean, to me that's innovation, right? It's using technology. It's moving off of conventional wisdom to provide that better outcome. And I think the other thing that these guys were touching on a bit that's important is that innovation's not static, right? I mean, we come to when we work on investment solutions, we come to the table with an idea, but it rarely looks like that original idea when it gets put into production, right? Because we go out, because there does need to be that diversity of thought. You're going out and you're talking to multiple stakeholders, record keepers, plan sponsors, participants. You're inputting all of those views, and I think that's critical to the process, and it ultimately you end up with a better outcome.
Awesome. Jake, you sit in a very interesting position as a consultant because it's your job to guide a client through new services, new products. How do you see innovation?
Yeah, it's a good question, and I think the next wave of innovation will be how plan sponsors and record keepers help them do this, but how they leverage data to lead to better outcomes. And I think each of us has mentioned outcomes, right? Innovation is great, but innovation that doesn't improve or move the needle as far as outcomes, I would argue, is not as valuable, right? And so, gobs and gobs of data. For example, if you have a participant that doesn't ever open email, but you've noticed they logged into the website, you may know a good way to communicate with that participant, right? If you know that you've sent a hard mail campaign to a participant and it's led to action on their behalf, maybe you know that that's a participant, that channel of communication is a better way to communicate. I've heard from some of the major record keepers over the last year or two as to how they're integrating not just demographic data, but usage data. Again, when does this person get on the web? What type of transactions do they conduct in order to create some profiles for them? And these profiles are tendencies which lead to action, right? So do people that tend to check their balance after midnight, do they have some commonality between them? Maybe they're all really busy with kids and college savings might be important. So we've seen a lot of data mining, but not just collecting data again. It's data that could lead to outcomes. And I guess the final point I'd like to make with regard to innovation is record keepers have a lot of great innovation, but the plan sponsors that are able to utilize that innovation are the ones that kind of meet the record keeper in the middle. And they're willing to not just sit back and say, hey, record keeper, we want you to do a retirement readiness campaign. Period, end of story. The clients that do really well, one of my clients is Maricopa County. And Maricopa County has done an excellent job from my perspective of not just sitting back and having their record keeper feed it and run their campaigns. They're actually going to their record keeper and they're saying, what do you have? What content could we utilize? And then their benefits and their HR is actually disseminating a lot of that information. So the plan sponsor is now telling Nationwide how they want to utilize their technology. So again, I think innovation has a downside, which is it's going to take a larger commitment from the plan sponsor to figure out which innovations are appropriate for them and maximize the outcomes that those innovations lead to.
And we saw some of that with the New York State Deferred Comp Plan, which won the RCAPE Award, right?
Exactly.
They had to go from point A to point B and put the effort into that. We've got a lot on the agenda, but we've got some questions about innovation. So let's start with one of our first questions. Is there a trend to add a VIBA or HSA to either DB or DC plans? So I'm going to turn it to the consultant in the room and the record keeper. Do either of you want to comment on that, adding that to the plan?
I mean, I would say I haven't seen HSAs and VIBAs in the like, so for example, 457, a county or a city that offers a supplemental or deferred compensation plan. I mean, the county or the city may be interested in offering that. Totally different group. So I don't see them running together, at least from the deferred comp. My gut tells me, though, the pension side of the house may be more involved with launching something of that nature. I've seen a lot of discussion, but the corporate space, from my perspective, is maybe a decade ahead as far as implementing those kind of tools.
Dan, a lot of integration going on right now with DB and DC programs. Do you and your fellow record keepers see these HSAs and bringing all these benefits together under one umbrella?
Yeah, I think probably two parts to that. We have seen a significant increase in interest in an HSA.
Yeah.
That's and not a ton of adoption yet, but certainly a lot of interest, and we believe that there will be a spike in that, and that'll be an area of innovation in government markets. There are a lot of similar type plans that are out there today that are integrated. You know, the 401Hs, there's a significant number of those. Those operate in a lot of the same way, right? It's a health savings account, and you need to integrate it with the retirement. And if you integrate it right and you show a holistic view, you can really drive not only better outcomes of, hey, I need to save more because I now know this health cost that I have in retirement, but then we've also seen that individuals that will actually, to my points earlier, that people will save more and use the benefit for the health account by not taking out of pocket, et cetera. So it's almost a double whammy. As far as the holistic view of retirement, I think as an industry we've done a good job over the last several years of really changing the dialogue from just exclusively the retirement plan, the 457, the 401A, whatever it is, and have incorporated a number of additional views, including health, including out-of-pocket costs or spouses' information. So you're getting a holistic view of the household, and as a result of that, we're seeing significant uptakes in participation, but in deferrals, in asset allocation, in how long they're going to stay in the workforce. So that holistic view, it's meaningful, it's getting results.
So Josh, did you want
Yeah, I was going to say, Jake, you made a point that struck me where you said different decision makers are making different things. And that was, I think this is where the innovation needs to happen, because I think we have lined up as when we make products and solutions, the way oftentimes our plan sponsors and clients are organized and think about these things, and these things get done in different groups and decisions. But really, as we said, for the participant, like saving an HSA is oftentimes just as like saving in a retirement plan. So thinking about this holistically. So I think there's challenges, but I think we need to try to think more holistically about an individual's situation. Yeah.
I appreciate that. And I had one other point I'd like to just articulate here is that a lot of these health HSA, HRAs, whatever A, those are effective in the corporate space because of high deductible healthcare plans. Right, and that's not as prevalent in the government sector. Right. So let's not lose sight of, we as NAGDCA need to understand how to interpret these products into our space. And you need to really look at, if you have a high deductible healthcare plan, these programs are very, very effective. In my organization, a corporate organization, I use that very readily, but make sure that you understand why people use those and if it pertains to your plan.
Another question that came through about integration, and I think several of you all of you really touched on retirement income. how do you bring that all in? How are you thinking about that from an innovative perspective? Because you either got to build a website, collect all the data. Dan, why don't you start that off, because you're doing a lot of work. Many of your fellow record keepers doing a lot of work on bringing in data and giving a participant that full view.
Yeah, and as I think about our industry, where we're at and where we're going, I think one of the biggest innovations is going to be about, or it'll continue to be focused on retirement income, right? But it'll be taking some of the artificial intelligence and some of the other tools we now have available to us, using big data and really using that to drive new outcomes, bringing in things like fintech. I think fintech is going to be something that we're going to hear more and more, even in our space, where we're going to rely on it. You take something, so all of us have transitioned back, back in the day it was, here's your account balance and this is what's important. That's kind of the holy grail. And we've really shifted that conversation to, we really need to look at income, and we project that in a stream of a monthly income, and that helps our long-term savers better prepare for retirement. So the next stage then is, right, you use fintech, and a lot of us have solutions where right under your projected monthly income and your lifetime income score, how well you're tracking towards retirement, you then have tools that you can very easily move along, and real time you can see, all right, if I increase my deferrals by 1%, it's going to cost me this much, right? So taking in all this behavioral finance that we've been talking about for years, and then if I click a button, I can make that change, and it's only going to impact me by a couple of dollars a month, and all of a sudden my lifetime income score increases. So I think the introduction of fintech, really building on the big data, is huge.
Real quick, can you just define fintech? Because I think that means a lot of things potentially to a lot of people. Break that down for us. I mean, I think that'd be good.
Yeah, I think it's probably as vague as retirement income or financial wellness. There's a lot of definitions out there, right? But to me, it's often, it's small organizations that, to the point earlier, it's taking something known and adding new application to it. It's innovating a process. And then I think the real trick for us as industry members, as plan sponsors, then, is how do we take those new technologies and couple them with our existing platforms, our existing experience, and drive that better outcome, right? Now with these fintechs, oftentimes something will hit, they're usually small startups or not much bigger. Once they get a great idea, they become much better funded and much larger companies. But that's generally how I would view it.
Oh, David.
No, I was going to kind of just add in. I think that the thing that's so fascinating about the DC environment, and we've talked about the multiple stakeholders, is Dan's hitting this from a record keeper angle, and there's the technology and there's the communication element that comes into it. But if we kind of take a step back and think about what's working today in DC, what's not working in DC, we're doing a great job of getting people to save for retirement, right? Through the use of automaticity, automatic enrollment, auto escalation, target date funds. But where we're falling short, and I think this dovetails into the retirement income discussion, is target date funds do a great job of bringing people to that age 65. Where they fall short is helping individuals spend down that asset base, right? So can you do that through technology? Can you do that through innovative product design, right? Making your default, enhancing your default to not just be an accumulation vehicle, but also allowing it to be a decumulation vehicle. Building in, is there an insurance element? Can you build in deferred annuities to take out that tail risk, that longevity risk? Can you dovetail in with the record keeper? They're coming up with much better technology around systematic withdrawals, right? So can you give participants the flexibility that they desire, from age 65 and beyond, up until that longevity insurance kicks in, but still take out that, give them that defined spend down period, leverage technology, leverage insurance, leverage all of the tools that you have available to you to create a more innovative, better outcome.
And to add on to that, Jeff, I think as an industry, we've done very well there. I agree. The financial wellness, I think it's going to be evolutionary, right? It's going to be constant iterations, but with that defaults, I think investment providers, record keepers have done a great job. Recently, the introduction of this idea of, hey, it doesn't have to be just a single default anymore, right? So that you enter into when you're 22 and you don't do anything until you're 65, and now you have to spend down, right? So now is this thought, and there's solutions around this of, hey, what if you have multiple defaults, right? So you have a default when you're 22 and you enter the plan. It puts you into an appropriate target date fund. You don't have a lot of complexities. You don't have a lot of income. And so a target date fund works great. But as you get older and your life becomes more complex, you become married, you have kids, you add all of these expenses, and then you start thinking about retirement, well, now you have a new default. So at age 50 or 55, whatever it is, you switch to another solution that will help you with that planning and that spend down. I think that's a huge part of our future.
So let's put this on the table. Let's talk about, I'm going to put on my Dr. Phil hat, okay? Better than Dr. Ruth. What, I think you both alluded to this, what isn't working? So I want to, instead of tackling what is working, because I think you're right, target date funds, many of you hit on this, automaticity, those things. What isn't, let's talk about the current state of affairs. Let's build on that. What isn't working today? And let's put all our cards on the table, and let's say what's not working and what needs to be fixed. And then we'll get to what does innovation look like and where we're going. So who wants to start with that? Let's start with you, Josh.
Yeah, I think, I often think about, I've been working with DC plans now for amazingly 23 years, and I think about 1.0, 2.0, 3.0, and I think we're kind of easing into 2.0 here, and I think a lot of it, certainly, I think a lot about the investment side of things, and 1.0 was where we were going. It was actually maybe 0.5 back when I started in the mid-90s, and plans were very kind of simple, couple options, and then we got kind of in 1.0, which was let's offer lots of people choice and lots of options, retail funds, every style box. And I feel like for a lot of plans, particularly large plans, we're moving to 2.0 more so on the investment side, and then certainly on the plan design side with auto features. But staying on the investments, I think we realized that wasn't working well, giving people lots of choice. So this is obvious. We've been talking about this for a long time. So I'm finally seeing a lot of plans starting to move, particularly larger plans. Some have been doing this for a long time, really thinking about the investments. It's not about a lot of choice, but it's also not about just simple and just let's go to the lowest cost no matter what. I mean, that's a choice that many have gone to too. I get most excited about those that are thinking about an institutional investment approach. At the end of the day, these are institutional investments. These are long-term investments. So why aren't we giving available to our participants? Many of you have associations with the DB side. There are just very thoughtful investments solutions that are being used by the biggest institutions in the world, whether DB plans, endowments and foundations, et cetera. Why aren't we bringing those to the average American worker if we think they're good ideas? Too often, first the excuse was, well, people need to look it up in the paper. Well, there's no papers anymore. And not many people actually did that. Or these are too complex for individuals. Well, most people are going to target date funds or other asset allocation vehicles. They're asking us, what's the right investment solution for me? So we have to think like, prudent investor standards. What do thoughtful institutional investors do? They tend to have a thoughtful mix of active and passive. They tend to look at diversifying asset classes, not just the simple asset classes. And I think from the investment side, we're seeing better understanding and appreciation of that. But I think we need to do more. Real estate's a great example. 80%, and I'm not just talking about REITs, I'm talking about direct real estate. 80% of institutional investors use direct real estate. Not only that, it's one of the most in-demand asset classes in the high net worth space. So this is a great diversifier. So why can't we bring that to the benefit of the average American worker who can't even get access to this on their own because they're not accredited investors? But if through a DC plan, you can bring these institutional investments. And everyone's going to come to different conclusions. of what's the right investments, but go through that process. And really, I think we have to stop thinking about people just need simple, investments. They need simplicity in how to use the plan and things like target date funds and auto features. But underneath that, we can put a lot more thought, I think, into the types of portfolios and investments we're bringing to the benefit of the average American worker.
Jake, I want to come to you. You're the consultant on the panel. Your fellow consultants are out there talking with plan sponsors, helping to provide solutions. What's not working? Are we stuck in neutral?
I think we're progressing, but what's not working, there's a very clear item that comes to my mind. And what's not working is measuring the success of a record-keeping partner on items that aren't oriented at outcomes. For example, I see a lot of organizations feel very proud that they have, for example, 10 dedicated representatives that conduct 1,500 meetings per year. And they penalize the record keeper if they don't conduct 1,500 meetings per year, and that's your sole metric. We can conduct 1,500 meetings a year, and this happens all day. It's happening right now somewhere where either nobody or one person shows up for that meeting. And you're giving the record keeper credit for adding value to your plan because they conducted a meeting. That's not working. That's not working. I would rather you don't conduct a meeting and don't get credit and meet somebody where they want to be met, whether it be on the internet or on the phone. The other really quickly is not understanding your audience and trying to slam a corporate pitch into a governmental plan. They're already automatically enrolled, okay? It's called a pension. So not understanding your target market is the biggest thing that's not working, I think, for not the plan sponsors. From the plan sponsors, again, it's not measuring outcomes from your partner. From the industry, though, it's not understanding the nuances of government.
Absolutely. Go ahead, Dan.
Yeah, a comment on, I agree with Jake. We share a client that actually the head of the board brought up that same comment, right? And his comment was really, it's as far as that idea of education and accountability, it wasn't necessarily that the education wasn't right or that it was bad. It was that we're looking at it wrong.
Right.
We're measuring it wrong. Instead of number of days, we should be looking at number of outcomes. And I think there is innovation there, back to the whole idea of big data, analytics. So we've introduced a fiduciary model with OnSite, right? And that was a first step, and it was a great first step because we could sit down and answer the age-old questions: where should I put my money? How much should I invest? The things that we couldn't do before. So we identified that 2 out of 3 individuals we met with would actually take a positive action as a result of that meeting. So we knew that worked. Back to innovation, it's taking something that you have and adding new application. We brought technology into that mix, and we took the big data that we collect. And now we can sit down, we can look at a population. So in this particular Midwest client, we can now look at everybody who's participating in the plan, those who are eligible, those who are closest to retirement, those who are contributing at a certain level. We can now identify with a collective definition of who needs the most help, right? And when we go out and we optimize that experience utilizing that data and that technology, then we can really pinpoint. We can go and sit down with participants that need our help the most. And when we do that, so we've introduced this over the last several months, we saw a clear difference before using that data and after. It was about a 31% increase to the number of individuals that we needed to meet with, and we still maintain that 2 out of 3 individuals taking a positive action. So the combination is it's a joint accountability, I would say, and it's a new perspective that we need to innovate, and it can work.
Can I follow just really quickly
sure.
on that? And to give credit to your organization, I was having a chat with Brian Morris from
Sure.
your organization. And I've heard this a little bit before, but he was very adamant about, as a plan sponsor, start out, what's the ROI per rep? What is the ROI? And it's not
Absolutely.
to sort of say, oh, your ROI is too low, you're fired. If the ROI is too low, you should look in the mirror as a plan sponsor and say, what can I do to make the ROI for this rep higher?
Mm-hmm. Yeah, agreed.
So we laid all our, I feel better now. We're having that kumbaya moment where we've kind of put out our faults, and now we're kind of moving to that next phase of trying to come up with solutions. What innovations are around the corner? And then I want to also ask this question, because it came in from the audience. Is technology going to be the biggest driver there? And how do plan sponsors evaluate the technology? And maybe we'll start with you, Jake, what innovations are on the corner? How do plan sponsors evaluate this technology? It's got to be something that you are doing a part of the RFP process, looking at what these folks are doing in terms of their infrastructure.
To be candid, I feel like innovation has surpassed sponsors' ability to digest it and apply it. So there's so much innovation out there right now. It's hard to say there's some new communication campaign or, everybody has an app. Everybody's mining data. The difficulty, though, is for sponsors to digest how effective are these technologies. And the real homework they need to do is say, what are our priorities and what technologies are going to support us achieving those priorities? I would argue the innovation can be as simple as looking at what's the composition of the people that are giving input to helping determine what are those priorities. For example, if Dan, Dave, and I were huge football fans and we decide we're going to create a communication campaign that's really going to resonate with our people, and we create some cool football-oriented campaign, stick it over the end zone and reach your retirement, and we're all loving it, we're loving it. And we send it out, we're thinking this 100% of people are going to respond, and lo and behold, 60% of the people don't even resonate with it. Well, the flaw there wasn't the innovation of the campaign. The flaw was we weren't creative enough in how we sought input to determine our priorities.
Absolutely. Dave, I want to come to you because you and Josh, obviously, are product manufacturers, investment managers. You're using technology. You talked about it. Josh talked about artificial intelligence, but how does that kind of intercede with what you all are doing?
Yeah, I think the next, in terms of when I think about what's around the corner, personally, I feel like we've done that good job of solving the savings equation. It's got to be about the post-retirement phase, and technology has to be part of that, right? And I think about kind of where is technology going to get delivered through?
Oh, it's a phone.
It's going to be your phone, right? We look at kind of the statistics. 90% of the world, there's mobile penetration, 90%. Smartphone, 80% in developed, 82% in developing, right? So everyone has access to these tools, or increasingly everyone's going to have access. So I think that's going to be how it gets delivered. From a product perspective, where when we go out and we talk, we've done surveys for participants, 80% of them say they want their plan sponsor to offer some form of a retirement income solution. They like that idea. Now, they also say we want liquidity, we want flexibility. I don't want to buy an annuity. I don't want to have my assets tied up. So how do you build and how do you use technology to thread that needle? How do you give them that flexibility to help them have liquidity and manage their assets in those important kind of really immediate post-retirement years, and then take out that longevity risk? I look at kind of where we're going from a statistic standpoint, right? The number of individuals that have lived past 100, it's quadrupled in the last 30 years. It's going to quadruple again by 2035, right? We look at kind of the fastest growing age cohort. It's those individuals that are in the 80 plus. That's also the area where you've got the highest levels of dementia, right? So how can you build in some form of security, guaranteed solution? And if you do that, you're reframing the question for participants, right? Now it's not you need to manage your assets for the rest of your life. Now it's you need to manage your assets, if it's a deferred income annuity, for the next 15 years. It's a much simpler equation to solve, and I think that's where technology comes into play, right? Because the retirement, what we're seeing, the behaviors we're seeing around retirement, it's not going to be a hard landing. It's going to be a gradual decline. More individuals are working past 65, that gig economy that's coming into play. I think you need that level of flexibility there.
Josh, Dave and Jake both bring up good points about due diligence and also the use of technology. You're responding to RFPs. You're talking to clients. How do you digest the technology that you are putting into place to support your systems, to support your managers, et cetera?
Yeah, well, it's obviously a broad category. There's a tremendous amount of technology that is being used to inform our asset, for security selection, thinking about, how to pick, what are the trends going on in the industry. But I would say when it comes to the DC participants, we can think about an asset allocation and building we can build you a target date fund that's good for the average American worker. We can build you a target date fund for your plan, looking at your average plan and your situation. And we know the math, at least how to help solve the retirement income solution for individuals based on their particular situation. This is for pre and especially as you get post-retirement. Personalization is needed, but we can't do that.
Yeah.
As an asset manager, I can't do that without having that data, having that information, and then being able to implement it. So this is where the technology is going to be needed, both to get more information about individuals. Individuals want and deserve personalized advice. Everyone wants personalization. That's what a lot of the apps are. That's when you get fed, Netflix, what film may be interesting to you. It's because they know more about you. And some people don't like that they're looking at you, but they like having recommendations that are very tailored to you. And certainly when it comes to making these big financial decisions, how much to save, how to invest, et cetera, it should be more personalized. So we need to get there. But then how do you evaluate that? I think one thing that I've seen as people have moved to more target date funds, but even more managed accounts and other solutions is these aren't only technology solutions, these are investment solutions too. There's a methodology behind there, and you have to evaluate that. Jake, maybe as a consultant you're doing more of this, but you have to evaluate that methodology and that approach and what's behind it to make sure there's substance behind it. Yeah. So I think evaluating even the methodology and the approach behind any asset allocation tools is really important. Are you seeing sort of more of a need for that, Jake, when you're looking at asset allocation tools or managed account tools?
Yeah, I mean, there's a large need, but again, I would tie it back of you can't really give a standard managed account pitch in government without factoring in the pension. Again, if you're just coming in saying, hey, we have all this corporate research that indicates it's a good deal, and it is, but again, tailor your message to your audience and understand that. Again, I hear people, well, you should implement auto enrollment and auto escalate and default them to a target date or a managed account. I'm like, that's great for my 401k, but how about the 16% I'm already having to defer to my pension?
That's right. Yeah.
And I have a client in Southern California, and things are very expensive where they live, and they have an issue with. Lately, they've had people after their second paycheck have had to quit. Yeah. Because they can't afford to pay rent after the pension deduction comes out.
That's right.
And you're going to ask these people to save more in deferred comp. Make sure you understand the message.
I think to that end, to all the points, technology is critical forward, right, for innovations. But it's how do we as service providers, how do we as plan sponsors make it applicable to our plans? We have barriers to innovation, right? It's technology. I can't. We have payroll problems. We can't get a DB feed to the DC plan because the state system won't allow us. There's statutory limitations in our place. With this continued fee compression on all of us, right? Does that hamper some of the spend that would go into innovation? So I think there's a lot of things that could keep us from being innovative. It's up to us to understand, again, our constituents and then best utilize that technology and adapt it, nuance it specific to our public plans and make it applicable.
Yeah, I think, Dan, you bring up an important point too. It's this, and I don't have an answer for this, but data is a huge challenge, right? I mean, how do you find that single source of truth in the sense that, that you can customize, but for the solution to be worthwhile, you need to have that holistic picture for the participant. That's what you're saying, Jake. You got to look at it fully.
Yeah, and to that end, I just want to interrupt you because this technology is something that's really resonating with the audience here, and in particular, the kind of two competing themes throughout NAGDA: need for data, because to Jake's point, your points, tailoring communications and education and to specific groups of people, but also, is there too much information, and how do you being ported over? Or can you have too much information? Maybe there's not enough information right now, but could you have too much information? You look around what's happened with Equifax, Capital One. I mean, I can just rattle them off. Is there a point where there's too much and you have overload with information?
So I would say there's probably two things there, right? To me, that you can't have an overload. We've seen when you get data, and the more data, if you have the right infrastructure and you know how to use that, you can really drive some meaningful outcomes. The second piece of that is cybersecurity is something that's not going away. And it's something that we all need to be ultra focused on, and those RFPs and everything else, and fee compression, we need to continue to think about as a priority cybersecurity and make that a priority for all of us, because the crown jewel, we always say, is our participant data. It's critical for all of us to protect that data.
Jake, you mentioned, I think you were tongue-in-cheek about number of enrollment meetings, but technology isn't, and I think Dan's made this point as well, that technology isn't the only solution. You need a combination with people on the ground. Is that still, in your conversations with plan sponsors, that's still important? Having the boots on the ground, being able to interact with people?
Very much so. But I think the right question is having effective boots on the ground.
Yeah.
And if you look at it 20 years ago, without the technology we had today, you may have had, again, if they didn't have the internet and email, you had to have more of a field staff or people in the field to get out there. But as the technology improves, I would argue that you should be trimming your staff over time, because technology is supplementing those resources. Mm-hmm. So, I think to ask the question of what are we trying to accomplish? What's the best way to accomplish that? Understanding that technology is growing and improving, and revisit. Again, is every rep in your plan still providing value? There will always be a need for in-person, though, from my perspective. It's just making them more effective.
So, Jeff, some numbers to that. So, if you look at technology and all, the various providers will have similar numbers, but if 40% of people who enter the website, they're going to take a positive action. Usually that's an increase to your contribution by about 25%, so that's significant. On average, 50 to 60% of participants come and touch the website, right? A face-to-face, I shared the number in the fiduciary model, it's 75% of participants take an action, and it's a pretty significant increase. So I think the two need to live together. Ultimately, we need to be engaging more participants, and we need to get them more involved, whether it's through technology on Dave's smartphone, or it's a desktop, or it's face-to-face. And then to Jake's point, it's measuring and figuring out that ROI, and then having the mindset and the willingness to adjust if something's not working and try something new.
Josh, I want to come to you, and start with you, Josh, and we'll come down 30 seconds, because we're unfortunately running out of time. We've got about 10 minutes left in the session, and we have a lot more to cover. But from a best-in-class perspective, what are plan sponsors? So you guys have put your heart and souls out there. All the cards are on the table. What are plan sponsors doing and not doing? What should they be thinking about on a go-forward basis? This is for all of you. So let's start with Josh.
Yeah, well, it's hard to be a plan sponsor. I mean, there's so much being thrown at you, and such an awesome responsibility. So I think plan sponsors are really trying to do all the right things, and many of them are. And I think where things tend to get hung up is just concerns on doing something a little bit different, being a little bit away from the herd. Even I can't tell you how many sponsors I say, yeah, I know I should be doing something with retirement income. I know I should be doing, maybe better investment solutions, but my peers aren't doing that. I'm worried what's going to say in the paper, on the corporate side. I'm worried I'm going to get sued for this. And that's it. And I feel for plan sponsors, but I think that's where many of them are getting stuck, I think, in doing these things that they know are right, but it's other things that are, the perceived perception, how it's going to perceive is hanging them up, and I think that's the big challenge.
Dan, certainly a hard job being a plan sponsor, dealing with all these different components. How do you see it?
Yeah, so first, I think as plan sponsors in public plans, you all are doing an amazing job. I've talked about engagement. We've all talked about engagement a couple of times. 91% of public employees have access or access their workplace savings.
Amazing.
That's in comparison to less than 60% of private organizations, right? And of that 90% who have the workplace savings, over 80% participation. Now that's DBDC, but that's a significant accomplishment. And kudos to all of you for doing that. That's the first step, right? Corporations, that 60%, less than 50% of those individuals actually participate in the plan. So you've achieved that. I would agree. It's back to the growth mindset and innovation, right? Of tweaking things that we know have worked and trying new. I would say, be open to new ideas. That doesn't mean just say yes, but be open to it. Push us for ideas. Push us for data. Give us ideas, and we'll go back and we'll curate those and figure those out. But I think we all need to be innovative and open to continuing to evolve our business, and we're going to get better outcomes as we do that.
David, yourself?
Yeah, I mean, just to Dan's point in terms of kind of that whole access and coverage issue, I mean, there's a great statistic that AARP put out that individuals are 20 times more likely to save if they have access to an employer-sponsored workplace directed account. So kudos to you. I think that's getting people saving is the number one. That's the number one piece of the equation. In directly to the question in terms of what I'm seeing in terms of the best plan sponsors, they tend to take a bit more of a paternalistic view, right? They put themselves in the shoes of their savings plan participants, of their employees, and they really think about the objective functions. What are they trying to achieve? And they also take a mindset, and Josh was going in this direction a bit, of, listen, I get it. There's been a tremendous amount of litigation. There are fiduciary concerns, and this litigation and the fiduciary concerns, I think the silver lining is they've retrenched us, and we've really focused on fees and costs, and we've taken a lot of costs out of the equation, and that's giving participants better outcomes. But on the flip side, we've lost the vision of value for fee, right? We're focusing purely on cost versus the value for every basis point of fee. And I think we need to shift a bit in that mindset and be more open to taking some risks. Don't spend just to spend, but think about it in terms of outcomes and where can you produce the best outcomes. And this is the index guy saying this, right? So I think there is an opportunity to innovate further, and some of that's going to be active management.
Yeah.
Jake?
Yeah, I think plan sponsors, number one, you got to have the right folks in the role to succeed, and so I work with groups where the trustees, some aren't even enrolled in the plan, and they're going to opine on how the website is, and they don't even have an account. How are they going to know what that is? I was talking with a gal here at the conference, and she's a retiree on her committee. Most of the committees I work with don't have a retiree, so a bunch of non-retirees sit around and opine about what retirees want.
Yeah.
I was working with another client. Well, we need to get the younger folks, these so-called millennials, more involved in the plan. We've got a bunch of 50-somethings talking about, bring them in. Put a retiree on your committee. Bring a millennial on your committee. Make sure you're representing all the different diverse constituents of your program, and make sure they have a voice and opinion, and that's factored into what's going on.
We've got about 5 minutes left. It's been an amazing conversation. I think the audience has enjoyed it because we still have a lot more questions. But I want to close things out with the future and where are we going? I think we've talked a lot about that, but where are we 20 years from now, 10 years from now? What does that look like? So Dan, aspirationally, take a minute. Aspirationally, where do you see things going?
I'll take a little different spin on this, and I'll go back to one of my opening comments. I think for us to truly innovate, it's that diversity of thought. And I think diversity of thought comes from diversity of the teams. I pulled some stats. Generation Z, we've been really focused on millennials. Generation Z, they're currently aged 6 to 21. They represent 30% or 32% of the U.S. population. This year, they're going to outgrow millennials. It's almost 50% racial, ethnic, minority based. This is a new way of thinking. These individuals, more of them are going to college. Less of them are worried about work-life balance. They're more worried about the income in retirement. So I think we need to be thinking about that. And then back to that diversification of thought, you think I'm just going to choose one area, but you think 55% of women now are primary decision makers for their households, right? 75% have gained more financial decision-making power over the last 20 years, yet only 17% of financial advisors are women. So companies, teams are as much as 158% more likely to understand target consumers when they have at least one individual in that group representing them. So when I think innovation, I think diversity of thought, and we as an industry, as plan sponsors, certainly as investment providers, consultants, record keepers, we really need to nurture that diversity of thought. That's how we're going to get really innovative, I think.
And if I could, I'd like that to be a call to action. You know, you look here, and you know, for those of you that come from, you know, these diverse backgrounds, be motivated, and you know, don't be afraid to step up and ask to be a part of your committee. Join a committee at NAGDA. We think these are all great things that are going to help move our industry forward, and that is the future.
Yeah, absolutely. It's collaboration. Josh and Dave, I want to hear from you as we wrap things up.
Yeah, no, I echo all of those points, and I think as far as retirement, I think the future is really thinking soup to nuts, accumulation to decumulation. I think that's putting the whole picture together for an individual and helping them understand, you know, if they have a, you know, some have DB, some don't. You know, again, a lot of your employees are very fortunate in the amount they have there. But thinking about that whole picture and really managing it from an institutional perspective. You know, the DC market is $7 trillion. The IRA market, I think, is about $10 trillion right now. And most of those assets came from the DC market. So, you know, we have the opportunity to provide institutional solutions from, you know, accumulation to decumulation, DB and DC, and putting it all together for individuals. But then thinking about all the, you know, what technology do you need? What new investments do you need? How do you help in guaranteed and non-guaranteed solutions? And really, you know, putting all the pieces together, I think, is where we're going.
Yeah, for me, the aspirational, I guess it starts with kind of that access and coverage issue. You know, it's not an issue for the plan sponsors in this room as a plan sponsor, but it's an issue for us all as Americans, right? If we don't solve that access and coverage issue from a policy standpoint, you know, we're all going to have to ultimately pay for that down the line. And then I think, you know, once we've got people saving with that level of access, it's what Josh was saying, it's that seamless experience for the individual. It's bridging the saving and the spending phase. It's overlaying technology into the equation so you can actually provide true personalization, customization, and you can deliver the experience. We're delivering an experience to the masses right now, but we've got to customize it even further.
Yeah. Jake, anything else you want to add? I know you...
No, I mean, again, I think just focusing on the segments of our society that our industry has not provided enough value to. And that's not a public service announcement. That is the biggest opportunity that I as a financial advisor have, and I think many of our record-keeping partners out there have, is to provide more value to places that we haven't added enough value, i.e. if you add more value, they're going to participate more, they're going to save more, they win, we win. So the future is expanding the pie.
Well, it's been a great hour. And, you know, time just flies when you're having fun. I mean, we could go on for more hours. I don't think NAGDA wants to do that at this time. But thank you to all of you. Thanks to the audience for great questions. Great job, panel.
Thank you, Jeff. Great job, Jeff.
Thank you. And I think we have an announcement.
I'll just close it out real quick. Thanks, Jeff, and thanks to all of you on the panel for sharing your insights and expertise. We really appreciate. And it sounds like we got a number of things to look forward to in the future. And I think it's been a really great conference. We've had a wonderful few days here in New Orleans. I want once again to shout out a big thank you to the conference committee and to all of you here who have made this year's conference such a success. And we will see you all next year in Seattle. Thank you, and safe travels home, everyone.